Okay, welcome to the Finimize Podcast. I'm your host, Eddie Donmez, lead content creator and analyst here at Finimize. This is the very first episode, so you know we had to start it off with a bang. Today, I'm absolutely honored to be joined by Daniel Ives, Managing Director at Wedbush Securities. He's an absolute legend on Wall Street, and I've personally been following him for probably longer than I care to admit. We're going to be covering everything tech today, layoffs, Tesla, Microsoft, ChatGPT, which is obviously all anyone can ever talk about right now, the FANG stocks and everything in between. So Dan, great to have you. How are you doing today?
Great to be here. Thanks for having me and excited to have a discussion.
Perfect. So let's start maybe by looking back at the previous year. So 2022 was an awful year, not only for tech investors or stock investors, but fixed income as well. But particularly in tech, it was a bit of a bloodbath. Where do we sit right now coming into 2023? What's the kind of outlook and maybe your kind of gut feeling with where we sit in the kind of macro cycle and how that kind of, what's your outlook for the kind of tech and stocks going forwd?
Yeah, I'd only compare it to 2008. From our perspective in 2001, coming out of the bubble, in terms of just what we saw with the stocks, multiples compressing, risk assets thrown out the window, and obviously just a Fed-driven rate hike environment where the New York City cab driver bearish on tech, right? And I think going in 2023, there's clearly two camps. One is the more bearish, and I think more the majority camp right here, that tech companies have never operated in an environment where money's not free, which is actually not true. If you go back to 06, 07, this is going to be massive multiple compression, recessionary environment, cuts are going to happen across the board, tech's dominance is over. Now, then there's the other camp, I think smaller camp, which is our view, that 2023 is ultimately the starting of what I believe is going to be the next growth cycle. How did 09 start? Had 2002, 2003 start? Cost cutting, reining in expenses, focused on strategic areas, whether it's the Microsofts, the Amazons, the Apples, and others. And then if you look, the fourth industrial revolution, that's not changing. And then you could argue it gets pushed out 6-9 months in this macro mild recession that's baked into stocks. My view, so much bad news is baked into these names that I think we go through earnings, you'll have number of cuts across the board, rip the Band-Aids off, stocks are up 5-10%. That's my view. That's why I believe tech stocks are up 20% for the year. I think FANG stocks could be up more, as well as names like Tesla and others, just because it's as underinvested as I've seen tech since 2009, and multiples are below even the 5-year mean.
Mm-hmm. And I've been listening to your commentary as before. Is it fair to say that a recession or a mild recession is baked into your thesis now in terms of the numbers?
Baked in. I mean, it's baked in like a cake, 350 in the oven. I mean, that's also why a lot of times you'll hear like strategists, economists. Remember, I sat next to an economist for 10 years in New York in my previous firm. I mean, if I listened to them, and phenomenal, super smart, 10 times smarter than I am, I never would have bought a tech stock from 2005, 2015. Just to caveat that. But right now, it's like numbers have to come down. We're going to retest. The street whisper numbers are already 10 to 15% below street. Let's just be clear. So that's why you have so much bad news baked in. Investors already are starting to look through the next quarter or two to what kind of the exit sort of trajectory is going to be in 23 and what 24 numbers are going to look like. So that's just an important thing to understand for investors, where it's easy to get caught up in the headlines, negative, recession. At the end of the day, Fed's in ninth inning. I mean, they could Fed talk and talk tough all they want. In this game of poker, streets basically called their bluff. So they're in the call it ninth inning of rate hikes. Now it's about the recession, darker macro, firms cut. And now what I believe it leads to the next growth cycle.
Yeah. And when you're speaking to institutional investors, would you say that tech is under-owned right now? Is that the feeling? Because there's a common phrase, watch what people do, not what they say. And many are saying, earnings recession, earnings come down 10, 20%, whatever. Is that what people are doing? Are they selling tech? Is it under owned? What's your when you have this access to institutional investors, what kind of questions are they asking you, and what's their general kind of feeling?
Yeah, institutionally, I could tell you in 22 years doing this, 8 of every 10 bearish, underweight tech. Because it's like, oh, no one wants to be ahead of number cuts. You're afraid of what's around the corner. Street's not factoring it in. Multiples could compress further. Now, look, those are fair arguments, but that's why, it's a battleground now. But no doubt, I think what you're starting to see is that fundamentals on the margin are holding up better than feared. That's all of our checks coming from Asia and enterprise. I'm not saying 5, 7, 8% of deals are not pushing, but you're still looking at 2.7, 2.8 IT spending environment, down from 3.2. Areas of software and cybersecurity are still going to go 15, 20%. Street's baking in that they're going to go 7, 8%. And I think that's ultimately why it becomes a knife fight. That's, right now, after a dozen years of just being so wrong. If you're a bear, the only ways you could have been more wrong is if you were negative on Messi, Ronaldo, Tom Brady. Pick your spot. Them being bearish in tech, right, for a dozen years. 2022, home run. Bears were 100% right. Bulls wrong. Now they're just doubling their bets. We believe they're wrong. We believe we sit here 2023. The street's already baked in what's happening in the macro.
Yeah, well, if you look at the macro from the Fed's perspective, like you were referring to, arguably most of that bad news is behind us, right? Inflation's coming down quickly. You've got goods inflation coming down. Sure, there's some, I guess, unknowns about services inflation and whether that remains sticky, but arguably a lot of the tightening is behind us, and now investors are looking to price in, look to the future, because that's what investing in stocks is all about, right?
And the Fed right now, we're in Vegas at 2 a.m. You're at the craps table, and they're like, I feel real good with their hand. Now everyone at the table is like, oh, let's call it, right? In other words, that's essentially what's starting to happen here in terms of playing out, because I think what you've really seen is the Fed, and I'd argue I think the Fed's actually done a good job, because soft landing, if you go back 6 months ago, no way. There's no way soft. Today, 40%, 45%. You even see coming out of Davos, right? Soft landing starting to become a narrative. You get a soft landing, tech stocks rip massively higher. Mild recession already baked in here. And that's sort of our view. Quality tech. I'm not saying profitless tech, froth, meme stocks, some of the others that they don't sort of go by the wayside, just like we saw dot-com bubble burst 08, 09. Quality tech, it's not the end. And that's why it just shows, I think, you look at Meta since those cost cuts announced. Look at Salesforce. Look what Microsoft's doing after cut. That ultimately leads to the next cycle.
Yeah. And let's touch upon quality, because I'm glad you said that, because we ran a survey with our million, subscribers, and they are, they're optimistic about big tech, and that, is somewhat of a safety play, right? They want to stay invested, but they don't want to touch unprofitable tech and things like that. So let's talk about Microsoft, but then maybe get on to the FANGs. I think you've got an outperform on Microsoft. So there's been some great things going on at Microsoft. Well, not today, but we can unpack that. ChatGPT, Microsoft Azure, that kind of whole integration. Can you talk me through your thesis on Microsoft? Is it gold star, big tech? Is it the best out of the FANGs? What's your whole thesis on Microsoft? And Obviously we're seeing PC sales slow a little bit. You're saying the enterprise is going to hold up a little bit better, but cloud is undoubtedly slowing a little bit. What's your kind of view on Microsoft right now?
Well, first off, let's just go back to mid 90s, late 90s. Gates, antitrust, Microsoft, battle with the U.S. government. They slowed down. They basically did no investment. Social, mobile. It's the biggest regret Gates ever made. That mistake's not going to be repeated. In other words, Nadella, innovation, left lane. They're going to continue to focus on that. They'll cut costs around the edges. But in terms of pure play cloud, Hall of Fame, gold star type name, in terms of it's Microsoft. And the other thing I'd focus on is you look at ChatGPT, you look at Activision, they're not backing down versus FTC because Nadella recognizes cloud's less than 50% penetrated. In times like this, companies ultimately emerge stronger, not weaker. But it goes back to they're not going to repeat the same mistakes they made mid to late 90s, cutting costs, going into bunker mode. And that's what's important about what's happened overall in tech here is that it ultimately is just going to create the next cycle. And I think that's why Microsoft, I'd say in some ways, more offensive than defensive. And let's just put it in frame of reference. They've hired 75,000 people since 2019. They're cutting 10,000.
Yeah, I think a lot of the headlines will grab, Microsoft laying off 10,000 people, but you can see on Wall Street, it's the same with tech companies. They've overhired, overspent. The party's somewhat over for now, the really good times where you can grow your headcount so much. And now maybe it's just a bit of a trimming and a bit of cost control. How do you think the markets will interpret that? Will cost discipline be rewarded going forward? Because before it was about growth at any cost. Now, how do you think the markets will respond to 10,000 people being laid off at Microsoft?
I think, obviously no one wants people laid off, but it comes down to it's a positive because it's focused on margins, focused on preserving the bottom line. That's why look at Meta. Stock's up 45% since they announced cutting costs away from the metaverse strategy. That's what Wall Street wants to see in these periods. And remember, they're going to start to hire again. But as you go through this near-term period, that's how you have to navigate it. Prudence. But also in these periods, never underestimate how bad a management team could be. And never overestimate how good a management team could be. Because in periods like this, that's what sort of separates, right? And it even goes back to Tesla. And after that Cinderella ride, now it's Musk, okay, be the pilot on the plane, get us through, what are you going to do? And that's why, and we'll talk about that separate, but this is a very, very important period in terms of sending signals. Also valuations. Valuations we see in the private markets, not necessarily just going to be growth, margins, profitable growth. Profitless tech, a lot of them, they'll get squeezed out, have to sell at lower multiples, valuations will come out, hubris will come out, but it's all part of the cycle. Saw it in 2002, 03, saw it in 2009, 2010, that ultimately led to those cycles. And just last, I'd say, those investors free money, party's over, this is it. Okay, go back to 05, 06, 07. So years more normalized rates, more discipline. I view that as a positive. It's not the end of tech dominance, in my opinion.
Is it fair to assume or infer from what you said that there's going to be a lot of casualties with those that are just, were kept alive, let's say, by the pandemic fueled rallies and things like that, but the real pure play gold standard Microsofts are actually going to take share and come out of this stronger? Is it fair to assume that?
It's going to be a battlefield like Mel Gibson, Braveheart, one of those scenes. It's going to be pretty bad, right, in terms of what you see in tech. But ultimately, that creates consolidation, winners. The strong survive, strong get stronger, leads to the next cycle. Because when you think about some of the technology that we're talking about, AI, EV, cloud, cybersecurity, like a lot of the big data project. I mean, we're talking about fourth industrial revolution that's playing out. So I think that that's an important thing to just remember as we're going through this in terms of the growth ahead of us, as opposed to even like when someone will talk about like bubble bursts, and I was an analyst covering tech then. Like if you go back then, the markets weren't there. That was more we'll call a hype cycle. I think that's the big difference to where we are today.
Yeah. And just you mentioned AI, and I just while we're on the topic of Microsoft, we have to talk about OpenAI and ChatGPT. I know it's relatively fresh, kind of
Listen,
out.
you think we're actually doing this interview? It's really a chat GBT that superimposed me. See that
You,
you never knew it.
you never know, and look, easily I could be speaking to the AI generated Dan Ives, giving me all of his one liners, but it's incredible the applications and how it's captured sentiment. Look, it's early days, you know, but the optimism and the potential for this technology to be integrated into Azure that was announced yesterday, into Microsoft Office. Imagine never having to build a financial model again. Imagine never having to build a presentation again. How big of a deal is OpenAI, ChatGPT for the space and generative AI? But how big is it for Microsoft? Is this the
I think
next?
it's a generational type techno potential, right? I mean, we gotta see as they scale it, but it just goes back to like 10 billion in terms of an investment from Microsoft. Go back to LinkedIn, GitHub. At the time, I can tell you how they paying that for Git. How's that possible? But ultimately, that thing is paid multiples and multiples in terms of benefits to shareholders. But it goes back to Nadella is not going to go in the right lane 45 miles an hour as a right lane bandit right now. It's going to continue to focus on innovation, double down on cloud, strategic. You could chat GBT in terms of how they could ultimately take that, not just in terms of Azure, Office 365, on the consumer side. That, I mean, and it speaks back to Activision, right? They're not just going to all of a sudden, with the Beltway, ultimately just move away from this deal. They feel like they'll sharpen knives and win this.
Yeah. So would you say in terms of AI, in terms of like a pure play, if there ever is such a thing, is Microsoft the most exciting AI play? Obviously, you've got Nvidia in that kind of realm as well. How are you thinking about the best way to play the AI kind of movement right now?
I mean, of course, you have the Chinese AI, but what I view is in the U.S., it's not even a question. I think Microsoft is the AI play today. I think number one in terms of how they've established themselves. Now, of course, it's going to be an arms race. Apple, you look at Amazon, you look at other in terms of some of the things that Google's doing. But right now, I think Microsoft's really starting to flex their muscles when it comes to AI. And you start to think about the strategy that Nadella has built out. It's so impressive. But even you go back to cost cuts, okay? You don't fill a bunch of racks. Some people leave. But ultimately, in terms of relative to where this is for Microsoft, still in the massive stages of growth.
Yeah, and this is my attempt at a transition or a segue. So OpenAI, Microsoft, Sam Altman started OpenAI with Elon Musk back in the day. This is my segue to Tesla. He left the
Mhm.
board recently because of AI kind of conflicts of interest. So let's go and talk about Tesla now.
Yep.
What happened last year and how much of a distraction was Twitter for Elon Musk, and how much of an overhang was this for Tesla?
Well, I think it's a confluence of things, right? It's not just one, but let's just break it down. I mean, poster child Tesla in terms of risk assets. So obviously, in terms of the risk sell-off that we saw, multiple compression across the board, Tesla was clearly, caught up in that. But a big thing with Tesla, it's because of Musk and Twitter. And now, look, many will disagree, right, in terms of our view. But I can just tell you, talking to institutions every day, the Musk Twitter circus show was 70% of the sell-off, in my opinion, because Musk, most followed human in the world, modern day Albert Einstein, Thomas, Edison, went through a Howard Hughes moment, right? Now, you need a pilot on the plane to navigate this. So I think there was the attention, there was the Musk premium. That's a huge part of Tesla stock. Then all of a sudden, once you start to break technicals, sell out, then all the bears, right, that have all been hibernation mode, they all come out, stock gets it. Then they're like, oh, well, how come this can't trade like a Toyota, like a traditional auto company? Okay, but that's the difference. Now we've seen some changes. Do the price cuts, starting to be on the offensive. Go after consumer demand. In my opinion, Tesla's the most transformational company in the world, period. But Musk ultimately is a key part of that story. And that's why, from a brand perspective with Twitter and everything else, it has had an impact. I'm not saying that that's permanent, but it had an impact, specifically on the stock. Now, from a brand perspective, it's Tesla again, the offensive, cutting costs, increasing scale, and after what was a Cinderella ride, seeing some cracks in the macro and making the right decisions. I think, but that's also why. You think it's coincidental Musk being quiet on Twitter, do the price cuts, show pilot on the plane, stock up, whatever, 25, 30% from lows in a few weeks?
So I want to unpack that slightly. The bears are going to say recession coming, demand problems, potentially China, but we can talk about that. He's cutting costs. That's going to hit margins, hit profitability. On the other side of it, it's, let me flex my muscles. I've got pricing power. Let me put pressure on the other EV competitors, show them who's the big boss. And how much of this is a 3D chess move in the sense of, let me get more hardware cars out there so I can upsell fully self-driving in the future, 90% margins or whatever it is. How much is this a power play move, or is it weakness in demand, or is it a bit of both? What's your take there?
I mean, demand softened is no secret, and that's the macro. I mean, it's no different for Tesla than Apple, for any company that basically is in the world, right? In terms of what we're seeing, but here we're still in the second inning of EVs globally, and I think essentially Musk is playing chess, others are playing checkers. I mean, that's really what's happening here as it plays out. And then look, the bears, like, they hated Tesla at 10 billion, hated it $1 trillion, hated it 400 billion. I mean, the point is that will never change, right? I think, many of these bears, if they were NFL scouts, they probably would have been pretty negative on Tom Brady coming out of 2000 draft. So that is what it is. But in terms of going forward, I think Tesla now, investors, they look past near-term margins, focus on volumes, and focus when the equilibrium returns, what that looks like second half of 23 into 24. Because then you start to look at, okay, like, what does auto gross margins look like when it levels out? That's the important thing. And also, it goes back to the masses. You're selling cars at 60, 70, 80,000. You're never getting to 7, 8, 10 million per year. You got to go lower in terms of from a mass market. That's why you start to get US into 30,000, mid 30s into 40. Obviously qualify for tax credit on Model Y. That's what investors want to focus on. It's like not focused on sitting there maintaining prices. You're focused on going after the masses in what's an EV arms race, right? Not just GM, Ford, VW, and obviously 100 other automakers going after OEMs.
Mm-hmm. And we're seeing China reopen now. And obviously that's, I think you referred to kind of China being the heart and lungs of the Tesla story. This is a positive, right? For Tesla?
It goes back to, like, it's been the hugest positive, not just for Tesla, Apple, but I think for overall tech. China had to reopen. Look, the COVID playbook that was not sustainable. And I think eventually companies like Apple are going to be like, okay, we're out. I mean, we're going to start the strategic process to get out. It was untenable. Now, as you're starting to see that sort of lockdown situation, zero COVID policy, go out the window, it's extremely important. No, recessionary environment in China, but look at where, we start to see some recovery going in the second half. EV price war plays out, but that's important for Tesla and from a share perspective.
Yeah. And just transitioning to
And
kind of
I
close
just say,
it.
and Eddie, I would just say one thing. 2009, after, iPhone launch, 07, so many investors talk to, they're like, that's it. Apple, they're going to be the next BlackBerry. Recessionary environment. It's just a phone.
Yeah.
So the point is, like, for the most transformational company in the last, you could argue maybe the last 50 years, 100 years. So I'm just saying, like, in these types of markets, it's very easy to just look next month, 2, 3, 4. You got to be able to see through, and that's what the stocks are doing.
Mm-hmm. Yeah, no, makes sense. And just to close everything off, because our community are really looking to the FANGs and are actually quite optimistic about the FANGs as a kind of safety play, just like I guess as you are. How do you feel about the general kind of FANG complex? And I'm talking ones maybe we haven't discussed, like Apple, Amazon, Meta, Google. What's your outlook in the near to medium term for big tech?
I think FANG names could be up 30, 35% this year. I think they've cleared the decks. They'll clear the decks more in numbers. Digital advertising already capitulated. We saw that. I'd say in some ways it's starting to recover a bit. They've cut costs, peel back spending, and then you look at the underlying growth and valuations. I think these are tech companies that are going to continue to innovate. I look at names like Apple in terms of I think demand's holding up well. In terms of what we see for iPhones, I think service is going to hold up well. They'll cut costs, get through some of the China shortages, but that's our favorite name. And then I look at names like Meta, peeling back on that strategy, focused on social media, which is obviously the core competency. Investors are looking what that sort of profile could look like as they get through this downturn. You look at Alphabet and Google. I have to even say some of the parts in terms of what that Google Cloud business is worth, and investors are starting to realize that. Jazzy ripped a Band-Aid off at Amazon. Obviously took a pretty bloated company, and you're starting to look at what that cloud business is worth, and the consumer business is starting to recover post COVID hangover, and now we're starting to get to some normalization. You look at Netflix, and that's obviously one that really navigated through challenges, and content's king, and they're starting to have a lot more success on subscriber growth. And I think it goes back to a lot of these stocks are underinvested institutionally.
No, that's definitely good news for our listeners.
But it goes back to dinner table, cab driver, whether it's New York or London, they're going to be negative on tech, negative on the market. But I mean, I've seen it before, and I just believe that, like in the Fed in the ninth inning, and given what we've seen with valuations of risk assets, a horror show in 2022, I don't think it's a repeat. I think it's actually going to be a strong year for tech, and I think they're going to be able to navigate because, and also you start to get anything better than a mild recession, and it's a rip the face off type rally.
Yeah. No, well, you've been more right over the years, from pretty much spot on the way up, and there's been obviously volatility last year, but history tends to repeat itself.
But also your failures,
or at least
I think. But also I think the failures strengthen you, and you learn from them, right? Like in other words, like that's always been my view in the market. Like I think your failures, your calls have been dead wrong. I think that ultimately strengthens you. I don't view that. Yeah, at least that's how I've always viewed it.
No, and you can argue. I actually did feel for analysts last year because it was so macro driven. You can build whatever model you want and forecast whatever units you want. Inflation went sky high, and it was a very difficult environment for all assets, as we saw, even with fixed income. So it was a bit of a difficult year, but it looks that the worst is behind us, and going forward, particularly maybe in the second half of the year, which has got a little bit too consensus for my liking, but second half of the year, looking out to 2024 is looking a lot more optimistic. But Dan, look, we've hit
Thanks for
half an
having me.
hour, and it's been an absolute pleasure. And yeah, we'll have to get you on again.
Yeah, we'll talk soon. Thank you so much.
Thank